Welcome to the deep dive. We're here to, cut through the noise, get rid of the fluff, and just hand you the really crucial insights. Today, we're diving into Plug Power. They've been, well, pretty visible, right? Big ambitions in hydrogen, but also, let's be honest, walking a bit of a financial tightrope sometimes. Their Q2 2025 earnings just landed, and there's something pretty interesting right away, a huge shift in gross margins, and the stock actually reacted positively. It kind of suggests maybe, just maybe, they're turning a corner. So we're going to walk you through the key takeaways from their earnings call, their press release, save you the trouble of digging through it all yourself.
Exactly. And our mission here is really just to give you a quick but still thorough picture of Plug Power's latest financials, their strategy going forward, and the guidance they've laid out. We'll
Yep.
try to connect the dots on, the main things shaping their path in this pretty complex hydrogen sector. The idea is to give you that informed shortcut, help you grasp what's really going on with this hydrogen leader.
Okay, let's get right into it then. The headline numbers for Q2 2025. Revenue-wise, Plug Power, well, they definitely showed up. $174 million. That's a solid 21% increase year over year. And actually, even better, it beat the analyst forecast. What was it, $158.48 million? Beat it by almost 10%. That's pretty impressive. And the market noticed. The stock jumped 5.63% after hours, landing at $1.55, which is definitely worth noting when you think about its 52-week range. Pretty wide, like $0.69 all the way up to $3.32. But given that range and, some of the past challenges, how much weight should we really put on this stock bump? Is it just noise, or is something deeper changing with investor confidence here?
Yeah, that's a good question. What's fascinating, I think, isn't just the revenue beat, it's what's underneath it. Those electrolyzer sales specifically, they tripled in Q2. That brought in about $45 million the total. But the real head turner, and maybe where that confidence is starting to build, is the gross margin improvement. I mean, moving from negative 92% in Q2 last year to negative 31% this Q2. That's a massive swing. And it doesn't seem like a one-off. It looks like a direct result of their Project Quantum Leap initiative. Think of it like a really intensive internal restructuring. Like a startup tightening its belt to survive and scale up. For Plug, it's meant centralizing procurement, renegotiating contracts, optimizing the workforce, all aimed at efficiency, cutting costs, and getting better pricing. It's a big strategic push that's starting to pay off, clearly.
Okay, so Quantum Leap is making a difference. And that margin improvement, negative 92 to negative 31%, that is huge. But we should probably keep the bigger picture in mind, too. Investing Pros analysis still rates their overall financial health as weak. They're flagging concerns about profitability metrics specifically. And that's not just a side note, right? It feels like the central challenge for Plug Power right now, which takes us straight to their plans. How do they fix this? What are their targets moving forward?
Right. Their main near-term focus is crystal clear. Get to gross margin neutrality by the fourth quarter of 2025, Q4 this year. And that's really being driven by Quantum Leap. Again, that aggressive cost-cutting and efficiency drive you mentioned. We're talking workforce changes, consolidating facilities to save on overhead, cutting back on things like consulting fees and software costs. And crucially, they've got this new hydrogen gas agreement that kicked in July 1st. That's expected to really bring down their molecule costs, basically what they pay for the raw hydrogen gas. That should directly help margins in the second half of this year and beyond.
Okay, so tackling input costs directly, that makes sense. What about the top line revenue and just their overall financial stability going forward?
So for the full year, they're forecasting revenue of $700 million. And they expect revenue to grow sequentially in the second half of 2025. So Q3 better than Q2, Q4 better than Q3. On the cash side, the CFO mentioned they expected, quote, meaningful reduction in burn rate from the first half, which is important because, yes, they did burn cash in Q2, but this signals a clear plan to slow that down significantly. They ended Q2 with over $140 million in unrestricted cash, plus access to over $300 million more in debt capacity if needed. Plus, they're actively trying to cut inventory, aiming for at least another $100 million reduction this year. That frees up cash. And they're winding down these power purchase agreements, PPAs, those long-term energy contracts. They plan to cut those by at least $200 million a year, maybe more if they can buy some out early. The longer-term target, which CEO Andy Marsh emphasized again, is positive EBITDAS by 2026. So positive core operational profitability, taking out some of the non-cash stuff. It all points towards this strategic shift, moving away from just chasing growth at all costs towards profitable growth and preserving cash.
Got it. So that's the internal playbook, a serious financial overhaul, which sounds like a massive job. But for a company like Plug, especially in hydrogen, an emerging field, external factors can be just as important, maybe even more so. What are the big tailwinds helping them out right now?
Oh, absolutely. A huge one is the growth in their electrolyzer business. They've got a really solid pipeline, over 230 megawatts of these GenEco electrolyzer projects moving forward in Europe, Australia, North America. They expect more deals to actually close this year, 2025, and several big ones are heading towards what's called the final investment decision, or FID, in 2026. Now, for FID to happen on these big projects, you need a lot of things to line up: securing the power supply, the land, water access, getting the funding sorted, and critically, finding the off-takers, the customers who will buy the hydrogen. Plug is also trying to lock in value earlier with pre-FID agreements. And they highlighted some key projects like a 25 MW1 with BP in Spain and a big 100 MW1 GLT in Portugal.
That electrolyzer pipeline does sound strong, and yeah, it feels like demand for green hydrogen is really picking up steam. But, we've heard other tech companies talk up big pipelines before, and sometimes they don't quite pan out. What makes you think these plug deals will actually get across the line and through FID, especially with all those pieces needing to fall into place?
That's a totally fair point. I think the real difference maker here is the clarity coming from recent government policy. It fundamentally lowers the risk for these projects. Plug specifically mentioned what they call the One Big Beautiful Bill from July, basically referring to major tax credits. Section 45V, the Clean Hydrogen Production Tax Credit, or PTC, that's a massive deal. It offers long-term certainty, which is key. But even more important are the direct pay and transferability options. Direct pay means developers get the cash straight from the government. They don't have to rely on finding complicated tax equity partners, which can be really tough. Transferability means they can sell the credit to someone else. These two things together make early-stage projects way less risky. They basically guarantee a revenue stream and make the whole business case much stronger. Like the executives said on the call, this is literally reigniting a lot of the conversations in the U.S., turning potential projects into bankable ones.
Wow, okay. So it's not just a standard tax credit, it's structured in a way that really unlocks these huge capital-heavy projects. That is a significant tailwind. What about the other credit, the investment tax credit?
Exactly. And then you've got Section 48E, the Investment Tax Credit, or ITC, that offers a pretty hefty 30% tax credit for qualified fuel cell properties. It kicks in from 2026 through 2032. This is expected to really boost demand for their GenDrive fuel cells, mainly in the material handling market, forklifts and such, which has always been their core business. Customers are apparently already getting excited. They understand that even if they buy the equipment now, if it's put into service after 2026 starts, they can still claim that credit. So Plug expects this to drive new orders in the second half of this year, 2025, and then lead to significant growth in 2026.
That's fascinating. So policy is boosting both the hydrogen production side and the equipment that uses the hydrogen.
Sure.
Makes sense. Okay, beyond policy, what about their own hydrogen production? How's that shaping up?
Right? They're also pushing hard on expanding their own hydrogen generation network. Their plant in Georgia is apparently doing well. It's scalable, reliable, and crucially, they can adjust production based on electricity prices to manage costs. That's smart. Their Louisiana facility is ramping up, and they mentioned it's their lowest cost site for supplying their own needs. And they're planning to start construction on a Texas facility by the end of this year. They might bring in a partner for that by mid-Q4, and it's potentially supported by that Department of Energy loan program they secured. Altogether, these plants give them a production capacity of about 40 tons per day. That's pretty substantial for meeting demand as it grows.
And are there other ways they're making money now, leveraging their energy know-how? I think I heard something about blue hydrogen on the call.
Yeah, exactly. New revenue streams seem to be opening up through their energy transition business. They're using their expertise in things like renewable diesel and sustainable aviation fuel, SEF. Part of that involves supporting blue hydrogen projects. That's hydrogen made from natural gas, but where they capture the CO2 emissions, so it's much lower carbon. They see potential there for, quote, gross margin positive and profitable deals pretty soon in the coming months. It helps diversify their business a bit and plays to their strengths in complex energy projects.
Okay, that's a really good overview of the strategy and the, well, pretty positive external environment. Clear plan, helpful policies, expanding infrastructure. But like we said, no company operates in a vacuum. Even with this momentum and the new focus on profit, there are always hurdles. What are the potential roadblocks? What risks is Plug Power dealing with? Is there one that particularly stands out?
Yeah, that's always the crucial counterpoint, isn't it? And Plug themselves point out several key risks. First, supply chains, especially reliance on Chinese suppliers. That's a common issue for a lot of companies these days. Second, the potential for market saturation eventually in hydrogen. Though honestly, it feels like we're still pretty early for most parts of that market to be truly saturated. Third, just broader macroeconomic stuff, interest rates impacting project finance, maybe unexpected changes in regulations down the line. Those can always throw a wrench in the works. Fourth, they definitely face strong competition, particularly in material handling. Their fuel cells are up against traditional tech and also increasingly capable battery solutions. And finally, just the basic execution risk. Building out that big hydrogen generation network is ambitious. Getting new plants built on time, on budget, that's never simple.
Right. And what about tariffs? That seems to be a persistent issue in global trade these days. How does that affect TIG?
Yeah, they address tariffs specifically. The impact varies quite a bit across their different business lines. For hydrogen generation itself, they said the impact is basically zero right now. For electrolyzers, it's pretty small, maybe 2 to 3% impact. That's largely because they use integrators who source most materials locally, built around Plug's core stack technology. So fewer direct imports subject to tariffs. But for the material handling business, tariffs hit harder, over 10% impact on their costs. However, they say they're managing this through price adjustments and, importantly, by actively shifting parts of their supply chain away from China. An interesting point they made was that their competitors, especially those using lithium batteries for material handling, actually face a bigger headache from tariffs. So in a way, the tariff situation might even slightly help Plug competitively in that specific market, relatively speaking.
Okay, so wrapping this up, what's the big takeaway from this deep dive for you, the listener? Looking at these Q2 results, the guidance, it really seems like Plug Power is trying hard to balance that classic tech company trait, aggressive growth, strategic expansion into this huge hydrogen opportunity with a much stronger, maybe even urgent focus on getting their finances in order near term. Hitting that gross margin neutrality target seems absolutely key.
Exactly. I think the picture you get is a company that's really focused on executing a specific plan. They're making that transition, and it's a tough one, from just high growth and high cash burn to prioritizing profit and efficiency. And they're doing it while trying to ride these significant policy tailwinds. Those tax credits are huge, but also navigating all the complexities of the global market, the risks, the competition. It's a very focused, very challenging pivot they're undertaking.
It really is a complex sector, no doubt about it, and Plug Power feels like it's at a real crossroads. So final thought for you to consider. When you look at all this, the fast-moving tech, the major government support we talked about, but also those persistent market risks, how do you personally see the hydrogen economy unfolding over the next few years? And what role do you think companies like Plug Power might actually play in really pushing forward the global energy transition? Something to think about.